So for the next 5 days, this is what we're going to be looking at, right? It promises to be explosive. And the reason why it is tagged the bridge is that it uses the concept. If you know what a bridge is, right? You get to know that a bridge is something that cuts across over a particular obstacle. For example, it could be a sea where somebody is trying to journey from one particular point over the bridge to another particular destination, right? So in this concept, we're trying to see how we can move from being a struggling trader or being a trader without an edge, from being a trader, that is having so many challenges and obstacles weighing him down, to becoming a trader that eventually will become profitable. So we're going on a transitioning journey, all right? And our movement on the bridge matters so much well on how we are going to arrive to that particular destination. So hence the reason for the bridge. And as you can see in the course outline, we have 5 days for this program, which should be ending on Friday. And for this particular bootcamp, we're going to be looking at the introduction. We're going to be looking at, for day one, introduction and opening remarks, which I'll give soon, and then the foundation to market structure. Then on day two, we'll be diving deep into my concept, which have to do with the monthly dealing ranges, trading ranges. We're going to look at tomorrow, which have to do with ranges and building biases. Then number three, on day three, we're going to be looking at the quarter point theory and my daily range cycle theory, or daily range cycle concept. On the fourth day, we're going to be looking at points of interest, momentum, and my entry system. I'll be explaining to you why I take the trades I take, how I take the trades I take, and the rest of all of that, okay? And on day five, which is going to be the last day on Friday, we're now going to be putting it all together, talking about the psychology of execution. Then we'll do so many chat studies and then take so many examples, take some Q&A sessions, and then my closing remark, okay? And one thing, as I promised you guys, is that this video is going to be readily made available for you, free of charge. And as promised, I'm going to teach without having to hold back anything. I'm going to teach you guys without having to hold back on anything. All right, just exactly as it's taught in my private academy, I'm going to bring those knowledge exactly to you. Okay? And at the end of this video, I will either upload it to the free Telegram community, or upload it to the YouTube channel, anyone, so you can get it for free over there. So it's either you're accessing it from the free Telegram community, or you're going to be accessing the videos of the bootcamp. But then I'm going to upload it at the end of the bootcamp, okay? So after day one, after day two, after day three, I wouldn't really upload anything yet till the end of day 5, all right? So once we are done with day 5, I'm going to upload every single thing once, maybe on the 6th day by Saturday or by weekend. Just expect all the videos either on free Telegram channel, or you will see them in the YouTube channel, okay? So just stay tuned, just know that something big is coming your way, and come with an open heart, come with a heart to want to learn, come with a heart full of questions. I know there's so many questions regarding your trading career that you want to really answer. And for this opening remark, I want to make you understand that you must have heard it many times, but although an edge is important, all right, it contributes just very much little to the success in your trading. I want you to understand that, because many of you who are in this particular bootcamp probably must have attended one other bootcamp somewhere else before. Probably you must have been trading somewhere else before. And before I continue, I sent a disclaimer in the group saying that if you're completely new to Forex, you don't know anything about Forex, and this particular bootcamp might not really favor you, because I wouldn't spend much time trying to talk about introduction to Forex, what Forex is all about, and the rest of all those things. We're going straight into discussing what we have on the chart. Okay? So having said that, continue on what I was saying. Many of you must have been trading different strategies in the past. All right. Many of you must have been involved in different systems in the past. And now you are here to, still seek information. There is just that missing link. There is just this thing that you're waiting to click that has not really clicked. There is just this answer you're trying to find. How can you find that particular edge that works 100% of the time? How can you find that particular system that works 100%? The holy grail is what probably you're looking out for. I would like to make you understand, first of all, that there is no holy grail out there. And what I'm going to be teaching you, yes, it's going to be valuable. It's an edge in the market. It's something that, and one of the beautiful thing about an edge is that with statistical probability over time will always be in your favor, right? The statistical probability over time. So losses are, yes, not inevitable. You're going to have losses. You're going to see losses. You're going to see drawdowns. But then once you can follow this particular system, all right, systematically, you will just see the results. That is just the truth. Okay? And I want you to just have that at the back of your mind. And there is something that makes, most of the times you realize that there are some mentors that, okay, are doing well with regarding their trading system and their students are not even really doing much well as expected. It's because beyond just the strategy, another thing you have to cultivate is the mindset and the psychology of your mentor or your guide or your educator or whoever it is they are watching. It's something that you have to pay close attention to, because if there are things I'm really focusing on and you're not focusing on them, like for example, I don't kill myself when it comes to the strategy. There are laid down rules called trading plan that I actually follow. And my intention is just to always watch my heart, watch my psychology, watch my emotions, and always constantly track it to be sure that I don't go off at any particular point. Because at any point I go off, then every other thing is gone. Okay? So that is one of the things I want you to know. That in this bootcamp, I'm going to answer so many questions we are regarding giving you a particular consistent edge. You're going to understand how I trade. You're going to understand why I view the market the way I view it. You're going to understand how I approach the market. You're going to understand every single thing about my trading, my execution, the psychology behind and the reason for my trades. I'm going to be giving it all to you free of charge. And like I said, the video will be given to you free at the end of the bootcamp, so you can watch it over and over and over and over again. In so much that, yes, you need a mentor, but there is nobody that is actually going to fight you for that, right? You have access to many persons out there. And whatever system, some of you are if you're in your beginning stage, I will even advise you to do what we call the sampling method. All right. Go out there on Twitter, on YouTube, on Facebook, on Instagram, check out all the strategies that exist out there and find one that resonates best with you and stick to it. That is where profitability comes in. All right. So if you know that at the end of this bootcamp, this system is something you want to, then you want to dive deep into it. It's something you want to stay with, then you want to look to dive deep into it. But if you already have an edge, a system that has been working very well for you, I'm telling you the truth, you don't need a new knowledge. All right. You are probably at the wrong place. All you need is to sit back down, refine what you know, and become a master in it. Okay. Till it works out for you. And that was how we were able to stay with some of these things that we're going to be showing you. And then it's began to work out for us. Okay. So having said that, you are welcome. You are welcome. And I want you to understand that you've gotten to a point of no return. All right. Whatever it is that you're going to learn here, it's your final quest, it's your final search. There is no point wanting to jump any other place again. Once you can understand this, and once you can follow diligently from the day 1 to the day 5, and go into your chart and put in the work and go into your chart and study some of the things that I'm going to be teaching you, I'm telling you, you have no other reason to want to search. I'm so confident in the edge so well that once you see it, at least those of you that have been following our trade markups in the group chat, you will see that calling out biases is not really an issue to us. All right. We have a very strong system in determining bias, because one of the things that, or part of the things that makes a trader a good trader, number one, is what we call building bias. You have to understand that, okay, how do we get to build bias? Once you can build a bias, whether, because this bias is going to guide you on your entries. You don't want to be selling when your bias is bullish. You don't want to be buying when your bias is bearish. So we have a system with a very strong, if I should rate it, without boasting, without bragging, we have a system that can give you a bias, let me say 90 to 95% of the time correct. All right. Our bias building is very strong. Building a bias, whether we want to buy or whether we want to sell. The next thing you want to focus on after building a bias is on your execution. Then after your execution is your risk management and psychology. So this is what I'm going to be showing you. All right. You want to stay put and see how we build our bias, why we build our bias the way we build it, how we react. Because trading with the trend and trading reversals are also two different things. The market will not always be trending all the way up. You get that trending movement, you also get the reversal movement. How to utilize those moves is something that we're also going to be learning in this particular bootcamp. All right. So you have an edge that I'm going to be showing you, or I have an edge that I'm going to be showing you. You just want to stay true to it to the very end, okay? So let's dive right into it. Today we're going to be talking about market structure and the foundation of market structure, okay? Market structure, no matter what, is very much important. Anybody that downplays the importance of market structure, the importance of market structure, don't really understand how to trade. Although I've had persons say that they trade without market structure, so it's not really much of an important thing to them. But I'm telling you the truth, market structure is very, 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 very important. Okay? Understanding higher highs, higher lows, lower highs, and a break of structure will save you a whole lot. Now, many persons get things twisted up when it comes to market structure, and we're going to study and we're going to look at it. Like I said, I believe that those of you that are on this boot camp already knows what a market structure is. But then we're just going to go back to the foundation. It's always good to strengthen the foundation. Now, one thing about the foundation of a particular thing is this, is that when you're building a house, for example, and you want to add a new story building to the particular house, one of the things the engineers will always have to do is to go and look at the strength of the foundation to be sure that the foundation is strong enough, all right, before they can add a new story to that particular building, okay, a new level to it. So if it is that the foundation are weak, then you now begin to see some consultations here and there on how to strengthen it or how to go about the project at hand. So it's the same thing applicable to you. If you come into this boot camp and you just want me to go right into why am I entering trades or just doing chart analysis here and there, it's probably going to be very confusing and it's probably going to be harmful to you. All right, it's going to probably harm you because we want to strengthen that basics. We want to be sure that that basics, because every other thing you see from day 2 to day 4, even into day 5, putting it all together, hinge or we stand very well on market structure. Once the foundation of market structure is not there, every other thing is going to come crumbling, okay? So having said that, let's dive right into market structure. Now, there are basically 3 types of market structure, if you know that. And our first type of market structure is a bullish market structure, what we call a bullish market structure, where we usually see the market trending all the way to the upside. And what we have to be a bearish market structure, where we see the market trending to the downside. And last, we have what we call a ranging market structure, where we see the market ranging, all right, just moving sideways. The market is neither going up nor is it going down, all right? It's just moving sideways. Now, there are characteristics of a bullish market structure. But before we go even into these types of market structure, you need to understand what is a market structure. A structure in itself simply means a systematic arrangement of a particular thing. And that is what a structure is, that the arrangement of a particular thing is, it follows a systematic sequence. Same thing in the market structure now, or bringing it to the market structure. We're not talking about how the market moves systematically or the particular structure of arrangement with which the market moves. And like we said, there are 3 types of market structure. Number 1, we have it to be the bullish market structure. This is the case where we would usually see the market trend all the way to the upside. Market is just buying. A bullish market structure simply means that, the market is buying. A bearish market structure simply means that the market is selling. Then a ranging market structure simply means that, the market is just moving sideways. So how do you now know which market is bullish? There are certain characteristics of a bullish market structure and certain characteristics of a bearish market structure. Now, this is something that I will need you to understand. For you to know that the market structure is bullish, it will always form what we have here to be a low, form a high, then form what we call a higher highs, and what we finally call a higher low. Sorry, a higher low and a higher high. Sorry about that, okay? What we have here to be a higher low, and what we now have here to be a higher high. So, just a moment. All right. So these are the characteristics of a bullish market structure. You always see markets after they form a high, they give us a higher low, a higher high, and a higher low, right? We always see price move higher highs, creating higher highs and higher lows as they move. In a bearish market structure, after we get these highs, you usually see a low, then you will see this to be our lower high, and you see this to be our lower lows. In a ranging market structure, usually nothing happens there, all right? No highs, no lows being formed in the market. Now, having said that, I want us to go deeper to understand the rules guiding a market structure. There are certain rules that will guide a market structure because this is going to help us in our bias building and also in the concept of liquidity. For those of you who understand liquidity is or potential areas where price would want to, violate and stuff like that. So let's examine the bullish market structure using it as a major example. Now, there is a reason why here, or in its basic form, why here is called a higher low. Okay? After price gives us a low, you can see why it's bullish, because a bullish market structure, like I said, is just a market structure that signifies the market is buying or trending to the upside. So you just want to pay attention to it because you know that, okay, any opportunities when the market is bullish, I want to be looking out for are buying opportunities only. If the market is bearish, it's selling opportunities you want to be looking out for only. All right? Now, one of the things I will need you to know is this, is that in a bullish market structure, we call this a higher low simply because this low is higher than the previous low. We call this a higher low simply because this low is higher than the previous low. We call this a higher low simply because it is higher than the previous low. This is called a higher high because this high that was formed there was higher than, or is higher than, the previous highs. This highs formed here also is higher than the previous highs formed. These highs, same thing, higher than the previous highs, and just as we go right, okay? So, having said that, there are things or some rules that you also need to pay attention to when it comes to market structure. And they involve this, or they include this. Let me draw this just one more time. Don't worry, from tomorrow, just for the introduction classes, that's why I say all this drawing. But then from tomorrow, there's going to be a slide that will guide us in some of the other concepts we're looking at, okay, as we dive right into the main concept. So now this is what I want to explain to you. I want you to understand first and keep it at the back of your mind that you can never call a place a higher low until you've seen a higher high formed in the market. Now, this is going to guide you so much because there are times that you're going to see in the market, price will form something like this in a bullish market structure. After a lows and a highs, price will come down to give a what appears to be a higher low. You might see even a break confirmation here. And then you see a price movement like this, only for you to be calling this a higher low. That, okay, no, price is coming down, then you should retrace from here and start going up. And some persons call this structure, a low, a high, higher lows, higher highs, higher lows, and higher highs. I want you to understand that that is a very, very, very wrong approach when it comes to structure. All right? What makes here a higher high, just as the name appears to be, is the fact that it is higher than the previous highs. And this higher high is what gives validation to this higher low. So a higher low is only established when we've seen price create a new higher high. Now, if we begin to go into the chart here, or if we look at this, look more into this now, you'll notice that this particular point, we cannot call this here a higher low until we've seen price close above these highs. Even if price happen to come to give you a price movement like this, just know that the previous market structure that we are dealing with still remains this market structure and this market structure. I want you to understand that the market structure that we're dealing with still remains this market structure and this market structure, which is these lows and these highs. And until price breaks past this particular highs, that is when we can validate here to be our higher low. If not, price have the right to still come all the way up here, only to lead us to a potential break of structure. Now, before we proceed, I'm going to talk about break of structure, or let me just continue. I'm going to talk about break of structure, and you will now see the importance of this. Many persons make this mistake of, okay, there are some liquidity here, price came all the way up here, this is now a higher low, and then we can expect price to move like this. No doubt some days you get moves like that, but just understand that each time you see a price movement like this could serve as a potential internal liquidity to this previous price structure. So what validates, what you should just know is this: what validates a higher low is the formation of a higher highs. So if these higher highs have not formed, you cannot freely call here a higher low. This is one of the things I just wanted to keep you at the back of your mind. Now, the same thing is applicable to a bearish market structure, right? In a bearish market structure, you cannot validate here a lower high until you've seen a lower low formed in the market. No matter how interesting the thing looks like, no matter how sweet the structure may be, you cannot call here a lower high until you've seen this low close below this previous low. This will guide you so much well when identifying bias. It will guide you when identifying what we call our trading ranges or our daily trading ranges. It's also going to guide you when identifying a change of structure or when structure has broken. Okay? So now, having said that, I want you to keep this at the back of your mind. Let's now look at what a break of structure is. And then we're going to go into the chart to spot some examples of this. Okay? Like I said, today is just introduction and foundations. Tomorrow, we'll dive right into my concepts very much well, okay? And I will explain better more things. I know that you want to, it's as if you want to get every single thing all at once, but then with patience, okay? They will all come. So then what is a break of structure? Now, in a break of structure, we know that, for example, in this particular case, we have two types of, or three types of market structure, but let's focus on the bullish and the bearish now. All right, so we have the bullish market structure, and which simply means that the market is trending to the upside, right? We've seen market coming down from a particular low trend, and then we are trending to the upside. What a break of structure is simply the fact that, okay, there is a type of structure which is dominant here, which is the market structure, and all of a sudden we now start to see a change in the market structure characteristics that led us to have price start trading all the way to the downside. So price initially was bullish, all of a sudden it started becoming bearish. What happened? We usually have what we call a break of structure. What structure is being broken? A bullish market structure is broken, all right, to give us that bearish market structure. Now, how does a break of structure form? This is just the foundation, and this is the basics, which you should you should know already by now. Now, that a break of structure simply happens by, well, it happens when price disrespect a previous market structural point. Now, this is what you should know. In a bullish market structure, we have price creating lows, highs, higher lows, right? Higher highs, higher lows, higher highs, higher lows, and then higher highs. One of the things that you will notice consistently from here is that all the higher lows are being respected. That there is no point where you're going to say price come clear this particular higher lows. For price to remain bullish, we want to always see the higher lows respected. We don't want to see price go below the previous higher lows. That for price to remain bullish, as long as we are saying that the market is bullish, we always want to see the higher lows respected. The only thing where the market is going to aim for, the only liquidity points where the market is going to aim for will be the liquidity resting above. Will be this liquidity resting above, will be this liquidity resting above. But as long as the market remains bullish, we want to see the market respect these lows. In a bearish case, as long as the market is bearish, we always want to see market respect the highs and never go above it for it to stay bearish. For the market to stay bearish, we want to see the market respect the highs in a bearish case. In a bullish case, we always want to see the market respect what? The lows. At any point where we see a market structure close below a low or a higher low in a bullish market structure, that already is a break of structure, which we call a BUS. All right, that already becomes a break of structure, which to us is a BUS. And what we can potentially expect is a turning point from a bullish market structure into a bearish market structure. Okay? So you would usually expect and usually see this happen when a break of structure kicks in the market. This is exactly what a break of structure is. Okay? That the market was once following a bullish structure, then we had this break to now lead us to a bearish market structure. As simple as that, okay? So keeping it simple, this is all I'm going to need you to know regarding market structure. Now let's go into our chart and let's take one or two examples of that, okay? Just a moment. All right, so let me remove this. Straight to the chart. And best on a daily time frame. Don't worry, this is the JPY chart. Probably let me use GBP USD because I trade, like I said, I use or I focus majorly on the JPY pairs. So let me use GBP USD. All right. So this is what we have here now. Studying market structure. If you cannot see it best on candlestick chart, then you can easily just switch to line chart. But let's study the trend from here. Over here, we saw the market creating a bearish structure, creating series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. This is a lower low because, and okay, something I'll also say or something I'm also supposed to let you know is this, is that when it comes to market structure, I prefer following the body of a structure. Now, it's okay if you follow the candle wicks, all right? But I always prefer following the bodies. Now, why do I like following the bodies? Because it's in alignment with what the line chart will always show us. All right, so judging from the line chart, this is it. We have these lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And like I said, in the bearish market structure, we always want to see the highs being respected. We never want to see the highs being disrespected. But in this particular case, we got the disrespect of this particular structural high, which potentially led us to a bullish market structure. All right. So right there, we have a break of structure. Another very much interesting point, again, you will see here is this. The instant change of market structure here. We had lower lows, lower highs, lower lows, and price broke structure, because in the bearish market structure, which the market was giving us here, we ideally want to see market structure respect previous highs. But in this particular case, we got a disrespect of that particular highs. Price gave us a highs, a higher low, a higher highs, a higher low, and a higher high. Because like I said, I judge with the candlestick body. And if you look into this candlestick body properly, you realize that we got a close above this particular highs with the candlestick body. Turning to line chart, you will see it better. And then eventually, we got the break right here, because in a bullish market structure, price was trending down, it gave us the break right here. Now price is bullish. And in a bullish market structure, we never want to see the lows being disrespected. But right here, we saw the disrespect of that particular low, which led us to the bearish move. And price started creating what we have as lower lows, lower highs, lower lows, lower highs, and so on. Okay? So market structure is pretty much simple. It's pretty much straightforward. It's the foundation to every single thing market. It's the foundation to every single thing bias. It's the foundation to how the market moves, especially as a technical trader. You know, there are three major ways we tend to analyze the market, or we tend to analyze the market. Number one is we analyze the market technically, or sentimentally, or fundamentally. But as a technical trader that have every single thing to do with the chart, I want to know that market structure plays a big role in it. Now, with this foundation, or with the renewal of this foundation, when we start talking about bias building, you understand the importance of this. Because in building bias, you don't want to be trading against the market structure. No matter how little and no matter how insignificant it may be, you don't want to be trading against the market structure. In this particular case, now, if we examine here, you will see that the market has been bullish after these particular higher highs and higher lows. We got these highs, we got these lows, we got these higher highs, right? Then this is now what I said about this. Look at this. Take a look at this. Let me cut from here. Now, you know, many persons would usually come and say that, okay, this is a high, a higher low, a higher high, and then this is a higher low. Now, you remember in the rules of market structure, one of the things I said to you guys was this: you cannot call a place a higher low until what? You've seen a higher high formed. Because imagine calling this a higher low only for you to now eventually see price come all the way down to disrespect structure. So here that should have been, instead, what you should want to call it is a potential higher low, because it has the potential that this curve here, or this particular structural points rather, have the potential to lead us into a new higher high move. But what we are seeing here is a typical representation of this, all right, where price is forming higher highs and higher lows, only for them to come, failed, and then created what we have to be a break of structure right here. Okay, so you can see we've been bullish right here, only for us to turn to being bearish. And I would also like to state that in market structure, identifying your properly defined highs and lows is going to save you a whole lot of stress when understanding change in bias. In this particular case, we know that our previous defined higher lows is this particular lows here now, all right? And our higher highs is this particular higher highs. And the only reason we can call this a higher low is simply because we've seen price close above the previous highs, which is this highs right here. Okay? Now, price came in an attempt to create a new higher lows, but then they failed and led to the disrespect of these previous lows, meaning that this bullish market structure automatically is now what? Is bearish. So we can now begin to anticipate bearish price action. Now, the only time we're going so the identification of a particular low is going to guide you in the definition of your structure or your market structure. In this particular case, now we can see that immediately price closed below this low. That is a good indication that anything that we want to start looking out for should be selling bias. Potentially, we can now allow price come back up to give us some more bearish move, of which we got, all right, and the new bearish move. So what does this now mean for us? Higher lows, higher highs, then they give us a break here. This automatically becomes your lower low, because this was the low that broke the structure, not this low. If I should turn to line chart, for clarity's sake, this is your previous higher lows. This is your previous higher highs. This is the low that broke structure, making this our lower lows, and this is our lower highs that led to this new lower low, not this particular lower highs. This lower highs was formed inside of the previous bullish market structure range. So if I want to teach a novice now, I usually say, just call it nothing. Just know that all these things are just potential liquidities that were formed in the market and easy target liquidity. Okay? So the lows that we are much interested in is these lows and this high. So identifying your proper structural points will guide you a whole lot. So this was that lows and these highs. Then you have this price coming down here. This was the lows that led to the break of structure, making these our lower lows, then our lower highs, and eventually our lower lows. Now, why you can also call this a lower high is just as you have here, lows. This was the lower lows that led to this lower high, and eventually this lower high that led to this lower lows. That is what gives us the validation for this lower high. So what validates this lower highs is the formation of a lower low. But at the same time, this was the previous lower low that led to that lower high. That is why I'm much interested in this as my structural point than this particular high. If it is that we got these lows closing below, then it's a different story altogether. Okay? So having said that, the next thing I want to now focus on is, okay, more bearish bias, knowing that these highs and these lows are points of interest. I will only switch my bias to being bullish if I see a candlestick close above this particular highs. So we can now turn back to candlestick charts and see. Okay? So we got this move. Price did not close above that. All right? It did not close. So there are chances that we could still resume the selling move. Then we got these sales. We got a ranging market structure within this particular zone. And yet no break. All right? It's more that we are dancing right at this particular zone. We don't have that break of structure yet. So we are still in a bearish trend because price hasn't broken above yet. If we turn to line chart, you can zoom in properly and you realize that we don't have that break. The only time that I'm going to switch my bias to being bullish is after I've seen price action close above this particular highs. Now, did we get that? Sorry. Did we get that? Good. Now, automatically, we have this. So we can potentially just wait for some retracement to take price to the upside, and then we've resumed our bullish bias. Okay? So that is it. Simple market structure. And you can see how we became bullish. Now, there's something I will tell my students, and that is this, is that no matter how small a structure is, as long as it's on the daily time frame, it's very significant. Very, very significant. And this is something you'll be learning about my system, that no matter how small a structural point is, as long as it is on the daily time frame, it is very significant. Let me turn to line chart. This is it now. Okay, so automatically we had price giving us a bullish price action. Then they gave us a break, turned bearish, and gave us another break. Now we are bullish. So we have a lows, a higher lows, because this is not our higher lows now, because none of these broke the structures. All right. So this is now that higher lows that broke this structure. Now we can call this, this is that higher highs that broke this structure, the highs that broke this structure, not any of all this structure. Now this is going to be our higher lows. Then price came with a little retracement to give us what we have here to be a higher low and a new higher highs. That is how to interpret it. If price had come down here below these lows, no matter how tiny it may be, I don't count it as internal liquidity. I see those structural points as powerful as long as it is on the daily time frame. Like I said, emphasis on the daily time frame. If it is in any other time frame, I have absolutely no reason. And can you see how price is just beautifully respecting it? After that higher lows, we got the higher, after that higher highs, we got these higher lows, a new higher highs, and price is still respecting that particular structural point to give us this bullish momentum. You can see the counter trend they gave us here with an internal break, potentially leading us to the formation of a new high. If price had done anything to close below these lows, some of you will interpret it as internal liquidity, but I don't interpret it as internal liquidity. My model and my system makes me to believe that no matter how little it is, as long as it's on the daily time frame, it's of a very, very great significance. Like, it matters so much. If I can find some examples in the past, then I'm going to share. But no matter how little, okay, for example, look at this. Now, somebody is going to see this and say that this particular is just only one candle, so it is insignificant. But this thing you're calling insignificant, higher lows, higher highs, higher lows, immediately price closed below it. The seemingly insignificant particular candle led to how many days of a bearish price action? It led to about 13 days, which is 2 weeks bearish price action before we saw a counter break. Following that, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. Can you even see this small structure here that some of you might not see as important? How very much important it is. If you turn it to line charts, you will see it, all right? Lower lows, lower highs, lower lows, price respecting it, created a new lower lows, a lower highs, a lower lows. Immediately we got that break, then we got the retest and price continued all the way to the upside. All right, so I'm a firm believer that every time frame has a story to tell. Every single time frame has a story to tell. And when it comes to building bias and market structure, the daily time frame is not that time frame you just want to use anyhow. The daily time frame is that particular time frame that you want to follow with due diligence. Okay, you want to follow it with that, reading it exactly as it is. You want to see it exactly as it is without having to mix things up. Okay. Now, I sent, for example, today, I sent some trades on GBP, JPY, and I was telling you guys, watch out for some sales on these guys. Why? Now, if you look at this, is it, our daily market structure trend. Price coming from here created a highs, a higher lows, a higher high. And in so much that they gave us some daily evidence here that could potentially lead us, we cannot call here a higher low until we've seen a higher high formed. So every single thing here is just, let me call it a potential higher low, but not a defined higher low, because price have the right to come and still clear these lows before going. Now, somebody is going to actually see price clear these lows and think that our bias has changed bearish. No. Even if price happen to come and clear these lows, that is not a break of structure. For a break of structure to happen, our previous significant higher lows is what we want to see price disrespect. So this is that higher lows that led to these higher highs. We are still trading inside of this structural range. And until price breaks either this high to give us a new higher low or break either this low to give us a break of structure, we are still trading within this daily range. Now, they gave this particular move here. That does not now mean that, oh, based on this is now a higher low. Let's wait for price here and start buying to the upside. You want to trade cautiously because price would usually do this kind of thing to give you what we call an inducement, only for them to come and clear the lows before the main move to give you the highs. All right. So and just like we saw in GBP USD, in that GBP USD, something typically like this is what happened, where price gave us that higher highs, did as if they were creating a new highs only for them to lead to a break of structure. So and then this is exactly the same pattern here, right? Higher highs, higher lows, higher highs. They're giving as though they want to give us a new higher highs, but because they fail to close above here, we cannot call this a higher low. Because price have every right to want to still come all the way down to clear this as internal liquidity before buying all the way to the upside. Or even if they don't want to buy, they can also have the right to move from there to close below this low to change our market to being bearish. So yes, overall, we are bullish, but you just need to understand that getting a trade or looking for a buying position from this zone can be very, very dangerous. Hence the reason I dropped in the Telegram channel that let's see if we can potentially get these lows swept. Then after these lows is swept, we can now know whether we want to expect that buys to resume because we are still bullish, or a potential break of structure that will now lead us to a bearish market structure. Okay, so this is one of the foundations of market structure that you want to have in your mind: the higher highs, the higher lows, and the break of structure concept. Once you have this, every other thing will fall in place. Okay, once you have this, every other thing, like I said, once you have this, every other thing is going to fall in place. So this brings us to the end of today's class. All right, like I said, it's just going to be a max 1 hour class, and tomorrow we're going to be diving deep into my trading concept. or into my trading system. Now, tomorrow we're going to be looking at the MDR and the DTR, which is the monthly delay ranges and the daily trading ranges. Why I use them and how I use them. Once you understand monthly delay range concept and my daily trading range concept for bias building, you will never be able to unsee it. Ask my students, all right? Those of my students that knows about my daily trading range and monthly trading range concept knows how powerful it is. Like I said, it gives you accuracy with bias. 80 to what is 80, 90 to 95% of the time. Like I said, there is no holy grail, but I can boast and I can really boast that when it comes to bias building, I have one of the simplest and best system when it comes to building the bias. Where the problem always is not necessarily the bias, because many persons can easily call out bias, call out that the market is bullish or call out that the market is bearish, but the question is going to be the question of execution and entry, how to utilize those moves. All right. That is now what we're going to start studying from day three. We're talking about day two, bias building, monthly daily range, and the daily trading range. Then from day three, we're going to be talking about quarter point theory, my daily cycle range concept. All right. Then points of interest, momentum, and my entry system. Then day five, we'll now do so many chart studies, putting it all together in the psychology of execution. All right. How to utilize those particular trades to execute them properly. Then we'll take some Q&A sessions and closing remarks. But these Q&A sessions will happen every single day. So if you have a question, maybe from today's market structure classes that we looked at, you can let me know in the chat box and I'll address it. If none, that will bring us to the end of today. Tomorrow by 9 p.m., we're going to meet here again and we'll go into day two, getting to understand our bias building, all right? So that will be all for today, and I hope you've gotten one or two values from today's class. See you tomorrow. With the absence of any questions, see you guys tomorrow. It's a process, all right? Everything will not come to you at once. And like I said, it's just going to be a max 1 hour class. So every single thing, don't expect it to just come to you at once. It's a process. Follow the process patiently. By the time we're done on Friday, it's a new week, all right? And it's a good week. It's a good way to start your month as you launch into the second half of the year. By the time you are done with learning this, you'll be able to see the market the right way to see it. You'll be, especially by the time you're done with what we call momentum, you'll be able to understand why I will tell you guys, be patient. You see this particular zone, um, we might be having a retracement here, or we might be having a continuation from here. It will guide you. All right. My system is sweet, is interesting, and it can be applied to any asset. It can be, you can use it to trade only gold. If it's only gold you want to trade, you can use it to trade any asset. Me, I love the JPY. Now, why do I love the JPY? Or why did I choose the JPY? I choose the JPY simply because number one, it's not as volatile as gold. I've made money from gold and I've lost money from gold. Gold has so many things involved in it, and in so much that it moves very well, I don't like the risks, the volatility in that gold. All right, it has a whole lot of volatility. It's a heavy asset, so I didn't want something too heavy, and I didn't want something crawling like any of all those normal forex pairs. So I was looking for an asset that has volume, that is not as heavy as gold, but can also move. Because why will you have a very good edge and analyzing a very useless pair? Now, the truth is that when you have an edge, the pair you trade contributes to your success also. Because it makes no sense having a good edge and you're using it on a useless asset. Like some persons that will be trading something like NZDCHF. I don't know why you're using NZDCHF. Not that you cannot get trade opportunities there. Yes, you can. But it's a very slow asset. Why waste your time there? Look for assets that move. Some persons like focusing on the NASDAQ indices, the US 30. Some persons is the volatility indices, some persons is the gold, some persons BTC USDT, and other assets. I love the GBP JPY, and I just want to limit my scope to that. Hence the reason for choosing that. Okay. So yeah, Joshua, you said you have a question. I'm going to permit you to unmute, so you can unmute to ask a question, or you can still type it to in the chat box. But you can unmute yourself. I think I've asked you to unmute now, so you can unmute yourself and ask a question.
All right, Coach, good evening, sir.
Yeah, good evening, brother.
All right, please, my question is simple. I want to know if the daily time frame, according to your system, is the only time frame that gives an accurate market direction, market bias.
Okay. All right. So to answer that question, the daily time frame doesn't stand on its own. But like I said, I taught my community what we call the time frame price story. And in the time frame price story, it tells me that every single time frame has a story to tell. And once you can interpret their story properly, you'll be able to utilize the moves in the market. The monthly time frame has a very good story to tell. The daily time frame, the 4 hours, the 1 hour, and the 15 minutes time frame. Now, when it comes to confirming biases, there are two time frames. Sorry, when it comes to confirming biases, there are two time frames that are the best. Either you use to confirm with the daily time frame or you use the 4 hours time frame. You see these two time frames, they are the best when it comes to telling the story of a particular move in the market when it comes to building bias. So in my own case, I love using the daily time frame to define the bias and using the 4 hours time frame to confirm the definition of the bias I've made. So if I say on the daily time frame, my bias is bullish, I know that the 4 hours would usually support the confirmation of that particular bias. So these two time frames, I use them hand in hand. But before I also go to the daily time frame, I now make sure that this my bias building on the daily time frame is in alignment with my monthly daily ranges. All right. So they are all connected. But the best for me, yes, when it comes to building that bias is the daily time frame. I'm not saying that it is the only for other persons, but for me, it can stand alone as the only assets or the only time frame for building a bias. Even if I don't want to use the monthly time frame, which would be risky with my system, you can use the daily time frame just on its own. Okay. So I don't know if I answered your question, but the daily time frame is usually the best for clarity and for ease. Because if you say let you use the 4 hours time frame, this is what will happen. You might get wounded a little bit here and there before you actually capture the move. If you say let you wait for the weekly time frame, you might have to wait for too long before you confirm. The daily time frame is just that sweet spot. It's just that sweet spot for you to get a particular trade. Let me look for an example in this now. Just a moment. Let me look for an example in this. Um, Let me look for an example. So I don't know, Joshua, I don't know if that answered your question. While I'll be looking for the example, let me see something here. Hmm. I don't think you might be able to unmute yourself again. So just let me know in the chat box if that answered the question. I'll look for an example and then I'm going to explain better, okay? So now, okay, if we should take this, look at this daily break that led to this move. If you guys remember calling out, when I called out this GBP, JPY in the free Telegram channel, I said that after this daily break of structure, let's keep an eye on some bullish price move, okay? And we got the daily break and got about 2 days of buying before this retracement began. And before this retracement began, I also told you guys to be watchful that momentum is beginning to slow down and some retracement may begin to come in and all those things. I remember calling it out for you guys. In short, this was, let me not go back to look for that chart. You can go to the free Telegram channel, follow from last week price action. This was Thursday last week, and you begin to see all the chart examples that I laid out there. So you can see this daily evidence now. This was where the daily break happened that led to this bullish price action, at least for these 2 days. All right. If I had gone to the weekly time frame, all right, cutting it here now. So you can see this. This was daily price action. If I had gotten to the weekly time frame to wait for that evidence before I execute, one thing is going to be sure. All right. One thing is going to be sure, and that is the fact that I am going to miss out on this trade because the weekly time frame might not have given me that clear break, trying to wait for the weekly time frame break. All right, look at how the weekly time frame presented. So I would have been missing out on this because I'm waiting for some weekly time frame to close and all those things. Now, if I should wait and say, okay, let me trade it on the 1 hour time frame in terms of bias. Now, see the 1 hour time frame before that particular break happened. Check how many other break happened on the 1 hour time frame. Can you see the significant, very much interesting break here? Lower lows, lower highs, lower lows, and price broke structure. As if that was not enough. This was break number one that got disrespected. Another one, lower lows, lower highs, lower lows. Okay, no, this did not break structure right here. All right, so but at least you see that you would have missed out on a trade here because you are trying to wait for that break. Coming to the 4 hours time frame here also, you realize that the 4 hours also gave you something similar to that. Look at the 4 hours break. Lower lows, lower highs, lower lows, 4 hours break. It makes so much sense to find your price action from here to buy. All right. But then if you had waited for that daily break, you realize that all the things that were happening here was not happening on the daily time frame. If you were patient enough to wait for that daily time frame and trade in the direction of the daily time frame enough, you realize that the best trade would be to utilize this. You would have missed you would have saved yourself from so many unnecessary losses here. Wait for that daily confirmation and enjoy this ride to the upside here. All right, because that was now when the daily time frame gave you the presentation. This is it here. So why the 4 hours and the 1 hour were giving you reasons to want to resume your bullish price action? The daily time frame was telling you, chill, allow the confirmation to happen, then you can execute. And each time you find yourself waiting for the daily time frame to give you that confirmation, you save yourself so many unnecessary stress. For example, here, this is it. Look at this daily time frame break here now that led to days of serious bearish price movement. Did you know that if you had gone to the 4 hours time frame to follow the 4 hours time frame, or if you had gone to the weekly time frame now, let me identify here. Let me mark out this particular zone where the break happened. This was where the break happened, right? Let's assume you went to the weekly time frame trying to wait for evidence. Can you even see that before you would have gotten weekly break, this was where the weekly break happened, all the way below there. So you would have missed out on so many of the great day ride. So the weekly time frame, yes, can confirm bias, but before it confirms it, it takes time and you might miss out on great deal of serious moves. And if you say let you now go down to the 4 hours time frame, you would have also gotten wounded probably one or two, three times before you now engage in that particular trade. Because the 4 hours will be showing you stuff like, okay, you had these higher highs, higher highs, higher lows, right? Higher lows, then higher highs, higher lows, higher highs. 4 hours broke structure in alignment, then gave you lower lows, lower lows, and broke structure. You might be telling yourself based on 4 hours, the price is now bullish. After all, overall trend has been trading to the upside. That probably this is just an internal liquidity the price came to clear. For those that trade liquidity concepts, right? You might be seeing this as internal liquidity. The price came to clear, and then they've given you a 4 hours confirmation. Now it's time to buy. So you realize that if you had just followed strictly what the daily time frame will tell you, you'd notice that on the daily time frame, you would have been waiting for that break to happen all the way up here from that daily break to confirm your bullish bias. So when you follow the story, the daily time frame tells you, you save yourself a lot of stress. That is why I use the daily time frame. So for my bias building, all right? Every time frame has a story to tell. So I don't know if any other person have any other question regarding structure. If you have, you can just indicate in the chat box and then I'll mute you, ask your questions. With the absence of any other question regarding market structure or anything related to that, that will be the end of today's class. Tomorrow, we'll dive deep into my concept of monthly dealing range and in short, how to build a bias. And we're going to do so many back testing. In short, it's going to be an eye opener to you. It's going to be something that when you see it, you cannot unsee it again. And trust me, when you see it, you cannot unsee it again. It's a very powerful tool. It's a very powerful system when it comes to building bias, and it gives you that. If I should not say, before you said I'm too proud, say 90 to 95%, but it's not give you anything less than 85 to 80% and above when it comes to accuracy in giving you bias, okay? So having said that, thank you all for making out time to be on this call. The recording, like I said, I'm going to send them at the end of the boot camp. I will send them free of charge. You will get them free, all right? No strings attached, no, I'm not going to release video until you've paid money thing. No, I will send all this recording free to you at the end of the bootcamp. Either upload it to the YouTube channel or I send them to the Telegram group. So stay tuned and see you guys tomorrow, okay? Cheers and God bless. Trade safe, clap easy, don't blow your account. Study hard and see you tomorrow. Bye, guys.